Scott Wren, going back to you now, you're not worried, it looks like, about the AI trade, but put that into context for me, because NVIDIA is now 12% off of its 52-week high, Dell 37%, Supermicro 65%. I mean, there's some valuations here that appear to be perhaps trying to reset, perhaps not done.
Yeah, I think, John, they're probably trying to reset a little bit. And, you know, it's probably been 6 or 7 months since we've been overweight technology. We've been more interested from an AI standpoint, really, let's say for something like industrials, because, you know, clearly for electrical grid upgrades and data center building, I mean, somebody's got to build these things. And, you know, they're all in the industrial sector. So we like industrials. We've liked financials, communication services. We like energy when, you know, oil's anywhere in the 65 to 70% zone. So I think AI is out there. You have to have some exposure. You know, if you carry a even weight in technology, I mean, it's, you know, 32% of the S&P 500. So that's a load. So, you know, you've got the exposure there. But as we look down the road here this year, I mean, we're expecting some broadening earnings beyond just the Mag 7, and their growth rates are going to slow this year. And while some of these other companies are going to improve. So I think those are the sectors that we like right now. You know, we're still large cap over small. We're looking for an opportunity to maybe do something with small caps, but I think it's too early. The international economies, while they might be a little bit better in the second half of the year, they don't look all that great now. So, you know, our strategy hasn't changed a whole heck of a lot in the last 4 or 6 months. You know, we're still looking for rates to trade a little higher, and I think there's going to be opportunities in rates and stocks.
Okay. Dan, I'm looking at these notes from you, and something catches my eye here, and it is this idea that the myth of cash on the sidelines is how you phrase it. What do you mean by that?
Well, I mean, for a long time, especially when the headlines were saying that money market accounts had hit $7 trillion, you know, there was all this talk about that cash was sitting there, you know, ready to pile in to drive stocks higher. And I think that there's other reasons to think that stocks can be propelled higher, but it's probably not this idea of cash on the sidelines. First of all, you know, true cash out there, household cash is like 3 times that $7 trillion amount. So, you know, we got to put it in perspective. But the level of cash, you know, at households is actually below historical averages. So, you know, while cash levels have gone up, stock allocations have obviously gone up way more. And so, you know, while stock allocations are at an all-time high, cash allocations are below the historical average. And I think it's become more of a substitute for bonds than for stocks. And so this idea that all this cash is going to plunge and push into the stock market, I think is a little bit misplaced.
Okay. Scott, you just said something I want to dig a little deeper on, and that's the fact that you think rates are actually going higher from here. I mean, we've seen this back up in the 10-year. We're at 4 or 5, basically on the nose again right now. What do you think drives rates higher, and ultimately what brings them lower? And I ask this knowing that the Treasury Secretary, Bessent, last week made some very telling comments about the fact that the Trump administration is not focused on the federal funds rate and is not paying such close attention to what Powell and the others at the Fed are doing right now. They're focused on bringing that 10-year yields down.
Yeah, I mean, Morgan, if the 10-year yield touched 5% this year, that wouldn't surprise us at all. I think, you know, 5.25, we'd be pounding the table to extend duration here. I mean, we're even weight long term. We're looking for opportunities to lock in some longer rates. And you're right. You know, the administration, the Treasury Secretary told us this. We know the report card for Donald Trump is the stock market. The Treasury Secretary told us they're watching the 10-year yield. I mean, those are 2 critically important things. And, you know, we think we're going to be able to lock in some longer term rates. You know, if there's any hint of some sort of global improvement in the second half of this year, plus you've got some normalization going on. You know, a 3% 10-year yield is not normal. You know, 5+ is normal, but, you know, we're doing a little normalization here. You're probably going to see a little better synchronized, that's a strong word, but synchronized global activity here, and still this fear of inflation, what the Fed's going to do about it. Are they going to raise rates? I mean, that could give us an opportunity in equities, and it wouldn't take much given the run we've had to say, you know, you're 10% lower. I mean, that's an opportunity to buy stocks here. So you need to be on your toes. You're going to have some opportunities this year, and you need to be able to move when those opportunities present themselves.